Hello and welcome to this presentation on IFRS 13 Fair Value Measurement. In this session we'll give a context to and overview of the requirements of IFRS 13. Well, IFRS 13 was first effective from the 1st of January 2013 and was very much needed as an accounting standard. It was the first accounting standard that actually provided a one-place guidance for everything to do with fair value measurement. Previously there had been bits of guidance in bits of other accounting standards, but this was the first standard to pull it all together and present all the guidance in one place. And the standard itself was written in response to the credit crisis and illiquid markets. During this period of time people stopped trading and thus there were less observable transactions in the marketplace, and therefore measuring fair value became harder. And so the standard attempts to deal with giving advice to situations of measuring fair value, not only where there are observable transactions, but also where there are not observable transactions. And with that in mind, the standard has three levels of fair value measurement: Level 1, Level 2, and Level 3. Level 1 measurement is observable data for identical instruments. Level 2 is observable data for similar instruments, and Level 3 is no observable data and therefore fair value modelling. Well, a simple explanation here would be to consider buying a car. If you were going to buy a silver Ford Focus with a 1.4 engine manufactured in 2007, then you'd look up in the marketplace and you would find an absolutely identical one. You would find a silver Ford Focus 1.4 engine 2007, and that would give you a level 1 fair value measurement. It's observable data because it's based in a marketplace and it's for an absolutely identical instrument. All the key attributes are the same. However, it could be that when you look in the marketplace you cannot find an identical one. Perhaps rather than being able to find a silver one, you can only find a yellow one. And this is known as a level 2 fair value measurement. It's still observable data because it's based upon market transactions. However, it's observable data for similar instruments, and therefore the risk of this fair value measurement increases. What we have to do is we have to take the observable price for the yellow one and think about whether the yellow one might be worth slightly more or slightly less than our silver one. And having to adjust this observable transaction therefore introduces subjectivity and thus introduces risk into the fair value measurement. Now it could be that when we look in the marketplace we can't find anything at all similar, in which case we can't use level 1 because there's no identical transactions, we can't use level 2 because there's no similar transactions, and thus we are constrained to using a level 3 fair value measurement. And on a level 3 fair value measurement, this is where there is no observable data, and so we use a fair value modelling technique. Now we might assume an appropriate model for valuing the car is to say, well, the car has 4 wheels which cost £600, it has a steering wheel which costs £100, it has a CD player which costs £50, and therefore if we take those observable inputs we can see the car is worth £750. Now this is a very high risk model because of course in our model we may not have considered all the appropriate inputs. We thought about wheels, a steering wheel and a CD player, but of course a car has many more inputs to it than those things we've identified in our model. And having said the wheels are worth 600 for example, how do we know that is actually the case? So as well as identifying the appropriate inputs, you've also got to make sure that the values that you assign to those inputs are accurate. Now obviously we're using the example here of a car for simplicity, but if we stopped talking about cars and started talking about financial instruments, you can see how challenging it might be to make level 1, level 2 and level 3 valuations. It's worth pointing out some other bits and pieces associated with the standard as well. The first is the unit of measurement. IFRS 13 is always trying to measure the individual instrument, rather than measure the quantity being purchased by the company. For example, a company might be buying a 60% holding of the company's shares, and of course that 60% gives a control, and thus a premium is paid because of the fact that control is being achieved. But the objective of IFRS 13 is not to value according to entity-specific factors, but to value according to the underlying instrument itself, and therefore we must ignore those entity-specific factors. Now, the wording that we see in the standard is that the fair value measurement, therefore, will not be based on entry price, but will be based on exit price. For example, if you are purchasing a 60% holding, you are likely to be paying a premium to obtain control. Now that's to do with the specific factors of the entity rather than valuing the individual instrument. So rather than value on that entry price, we would value according to an exit price, which is deemed to be a more reliable measurement of the single underlying instrument being valued. And also, if our instrument is traded in a number of markets, then rather than use the most advantageous market, we will in fact use the most liquid market where the majority of transactions take place. For example, in one market we might be able to achieve £50 per unit. That might be the most advantageous price, and logically we want to trade in the market with the most advantageous price. But realistically, there might only be a handful of transactions that occur within that most advantageous market, and so if we want to get a more realistic measurement of fair value, we should value according to the most liquid market, which is the market with the most transactions going through it. So even though that market might only have a value of 40, we'd be more likely to realize that value of 40 than the most advantageous value of 50. So we base our measurement not on the most advantageous market, but on the most liquid market. So there we go, that's IFRS 13 in a nutshell, and thus we can see the key things to give consideration to. Level 1 is identical transactions for observable data. Level 2 is similar transactions for observable data, and level 3 is where there's no observable data, and thus we have to use a fair value model. And as we progress from level 1 to level 2 to level 3, we see the level of risk increasing. Do bear in mind in a question that we could be presented, for example, with a level 2 valuation, and during the year we could see that the instrument, perhaps an equity instrument, has thus increased in value. And that value may well have been recorded through the profit and loss account. Now, of course, if there is a level 2 valuation, we know that there's a degree of risk associated with this. And when we are assessing the performance of the organization, perhaps against key performance indicators, perhaps we should allow for some sensitivity analysis due to the fact that the level 2 valuation has risk associated with it. So do remember that every time the fair value moves, there is a corresponding entry either in profit and loss or OCI, and if that fair value movement is based upon a high risk measurement, perhaps we should allow for sensitivity analysis.